In this video, I would like to highlight the features of a managed account. Usually, an account could be managed by a professional on your behalf, or you may choose to manage your account yourself. In that case, you are a self-directed investor. So managed accounts, also known as managed investment accounts, are investment accounts where a professional manager or a team of managers make investment decisions on behalf of the account holder, on behalf of their clients. And so here are key features of a typical managed stock accounts. Number one is professional management. So experienced portfolio managers or investment teams handle the investment decisions, including stock selection, asset allocation, rebalancing, diversification. All those activities, are done for you by your financial advisors or by your professional manager, so that they make provision for that professional management by skilled, experienced managers. And once they do that, you should be able to have a better investment result. Number two is customized investment strategy. Customized investment strategy. So accounts are tailored to the investor's specific financial goals, his risk tolerance, as well as his or her investment preference. These can include adjustments based on changing market conditions. And so each account is managed based on the client's individual preference. And so no two accounts are managed in the same, in the same way or in the same format. It all depends on the need of the typical needs of a client, his investment horizon, his risk tolerance, his objective in mind. So these factors would influence how a given account is managed. Number three is active management. Managers actively trade and adjust the portfolio to capitalize on market opportunities or respond to changes, aiming to achieve a higher return. As the market changes, so the manager will take the change into consideration and see how they can adjust their accounts, to be able to take full advantage of the changes to reap a better result, to achieve a better performance for their clients. So these accounts are they're not passively managed, they are actively, overseen and managed by these professionals. Number four is diversification. Managed accounts typically include a diversified mix of stocks. It might include bonds and sometimes other assets to spread risk and enhance potential returns. And so a typical managed account, depending on the investor's preference, are fully diversified across sectors, industry, geographies, and even across different assets, so as to be able to enhance the potential returns the individual could get from his or her investments. Number six is personalized advice. Personalized advice. So investors often receive personalized financial advice and recommendation based on their individual circumstances and their peculiar objectives. So in this case, you have an individual, unlike the case of a robo advisor. In this case, an individual, a professional. You could sit down one-on-one to assess your investment needs, to assess your tolerance, your risk tolerance, to equally, take into consideration your time horizon and provides an advice that is tailored to your need, that is designed, if implemented, will then grant you or give you the kind of returns you wish to obtain from your investments. So these typically managed accounts provides these personalized services, and of course they tend to they charge fees for this level of personalized services. Number seven is reporting and communication. Reporting and communication. Regular performance reports and updates are provided, giving investors insight into their account performance and any changes made, usually maybe on a quarterly basis, maybe on a monthly basis, depending on your choice. They provide updates as regards to how your account is performing. If there's need for rebalancing, they will let you know. And if they've carried out any change, they will equally bring to your knowledge why the change was effected and all those things. So you are kept up to date as it relates to the performance of your investment, on how the account is being run, everything related to the running of your account, the managing of your account. You are updated on a regular basis. Number 8 is fees. So management fees can vary widely and may include a percentage of assets under management, performance-based fees, or a combination of both. Usually, some managers will only charge a performance-based fees. If they performed or if they outperform the market, this is what we are going to charge you. All right. Some will charge a performance-based fees as well as a percentage of the assets, the capital under management. It might be 1% or 2% of the capital under management, whichever one. So sometimes, like in hedge funds, they charge 2% of capital and 20% of the profits. So they call them 2 and 20. Kind of fee structure. So it's important to understand the fee structure before committing yourself. Ask yourself, you research and understand the obtainable fee structure for that particular managed account before you commit your capital, before you commit yourself to investing with the managers involved. So please give me a thumbs up, subscribe to this channel and like this video, as well as share the video to people close to you. Number 9, manage tax management. Tax management. Some managed accounts offer tax optimization strategies, including tax loss harvesting and tax efficient investment choices to minimize tax liability. Usually, when it comes to investment, you tend to pay probably a lot in taxes depending on the vehicle and the strategies you adopt. So when it comes to managed funds, the managers will invest your money in such a way that they will harness whatever tax benefit they can harness, so as to be able to give you optimal returns, on your investments, optimal performance, in your investments. So the key into tax reduction, kind of tax reducing strategies like loss harvesting. When you sell a stock at a loss, usually the tax implication is not much compared to when you sell a stock that have made gains. All those things are taken into consideration by your manager. Number 10 is minimum investment requirements. Managed accounts often require higher minimum investment capital, compared to self-directed accounts or robo-advisors. So in this case, usually you will need a higher level of capital, a higher amount of money, for you to be able to really secure the service of a typical investment manager, unlike you investing on your own. That's self-directed investment account, or if you employ a robo advisor. So the fund manager will charge more fees than these other two alternatives, self-directed or robo advisor. So the minimum fee requirement is relatively high. It's higher than what is obtainable from the other alternatives. Number 11 is access to research and resources. Access to research and resources. Investors benefit from the research tools and resources available to professional managers, which may not be as accessible to individual investors. Usually, you have access to high quality research materials, stock recommendations, and other services that are not available if you were to, manage the fund, manage your account yourself. If you are a typical individual investor, you may not have access to all those specialized, customized services that are rendered to, clients of a typical managed funds. So managed stock accounts are suitable for investors seeking professional management and who may not have the time or expertise to manage their investment account themselves. That is it. You want to invest and you cannot manage your fund yourself, then of course you will then have to delegate the management to an active manager. Of course, you do that, you know, with a certain level of fees attached to these arrangements.